A big week of central bank decisions coming right up from New York City this morning. Good morning, good morning. Equities just about positive, up nicely, up 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue. The Fed goes quiet.
The Fed is really in a sticky spot right now.
The 75 versus 100 debate.
There's a tug of war every time there's data out.
This relentless uncertainty about how aggressive the Fed is going to be.
Maybe we get to 100.
We started to see almost a 70% odds right after the CPI data.
We've already seen some Fed officials start to sort of discuss this as well.
Chiming in here and there about, whether or not they really need to do 100 basis points.
The markets have pulled back the expectations.
We've now gone down to about an 18% chance from a 70% chance.
Look, I mean, the Fed's in a difficult spot because some of this is messaging.
Right now, they are almost solely focused on the inflation mandate.
The Fed is going to, in rhetoric and in reality, stay right on top of this.
A stronger Fed reaction, raises recession risks.
The Fed is very keenly aware of that.
Good news for those of you that hate the Fed speak. It's over. We're in the quiet period. Joining us now is Morgan Stanley's Sankaran, Julie Biel of Kayne, Rudnick. Julie, first to you. We've heard the Fed speak. You've seen the data. Is it 75 at the end of this month?
I think we still have a little bit of data in front of us, and that gives the Fed some time to decide. The consumer confidence number was kind of interesting. It surprised to the upside. We also saw that inflation expectations were a little bit softer for the consumer. And because 2/3 of the economy is the U.S. consumer, if they themselves believe that inflation could settle down, that has important implications for any kind of price spirals we see. So I think if we continue to see slightly softer data, you have the option to go to 75 basis points. But if it's worse, 100 basis points is absolutely on the table. And I think we should all be aware of that.
Sri, what's your take?
I mean, our view is still for 75 in July, but potentially kind of more rate hikes for longer. But I mean, I think pushing the needle with respect to kind of 100 basis points in July itself, it's probably a bit too aggressive.
So you made a couple of points there. It's the second one I want to pick up on. I've tried to de-emphasize the importance of 75 or 100 at the end of this month and really highlight the importance of the debate about the second half of this year and the upside risk to rate hikes. How many more do we have after this one? Sri, where do you come down on that particular argument?
So Ellen and our economist team, we're still kind of talking about 350, 375 as being the lower and upper bound into year end. But I think the bigger tension is going to be around what the market is pricing in with respect to 2023. So if the rate cuts which are being priced into the second quarter of 23, that seems a little kind of contingent on inflation, obviously showing clear signs of peaking into the back half of the year. I do feel like that's where there's going to be more tension, and it feels like you could end up seeing more of an overshoot with respect to early 23 rate hike expectations before the market kind of normalizes.
Julie, are you on board with this rate cut story for 2023?
Yeah, I mean, I think what we criticized the Fed for last year was not paying attention to the data and paying attention to their narrative that inflation was transitory. And now I think they've heard us and they're like, we're going to pay attention to the data. So without actually knowing what the consumer is going to do going into the second half of the year, I think it's hard to really predict very long term. But I think it absolutely makes sense that if they overhike and overshoot, I think they will cut. They're trying to be more responsive, clearly. They're just in a real Sophie's choice position where it's, do you crash the economy or do you get inflation under control? So I think it's just going to be very data dependent. It may be more reactive than we would like, but frankly, considering last year's sleeping at the wheel, I think that's preferable.
Pick your poison. Mike McKee, we've gone from rate hikes to rate cuts. The conversation shifted very quickly on Wall Street over the last couple of months.
Yeah, what a week last week we saw when the CPI came out and everybody decided 100 basis points was going to be it, and then it wasn't. We saw the Fed funds futures quite volatile as people try to digest the numbers that came out. And here's some of the reasons why. Of course, we had the CPI numbers come in extremely high, over 9%, multi-decade highs, followed by PPI. And the Fed has always said that the labor market is strong and can withstand more interest rate increases. But then you have real rates, retail sales going negative. Gas prices have been falling now for over 30 days. Recession odds are rising. Expectations are falling. And then you have the various Fed officials we did talk to before the blackout telling us we're not expecting 100 basis points. We're thinking 75 is going to be enough. A couple of quotes from people that really matter. Remember what Chris Waller told me, just because you do 75 doesn't mean you haven't done your job. It's really high. And I think we have to end by looking at this quote going back to June 29th from Jay Powell, the chair of the Federal Reserve. I think we now understand better how little we understand about inflation. So bet on 75, but you never know.
Mike, 250. You've got to think about how quickly we've got there. Mike, compare and contrast this rate hiking cycle to the previous one. It took us from December 2015 to December 2018 to get to 250, and we'll have done that between March to July of this year alone.
Yeah, wait till the end of the year when we get to 3% or over. But the difference is there was no inflation as we came out of the last recession, and growth was really slow. Growth has now slowed down here. The Fed is raising rates, but the labor market is still very strong, and inflation numbers keep going up. So the Fed thinks they have very little choice to react more quickly.
Mike McKee, thank you. And to Julie's point, the reason they've got to react more quickly is because they were so slow in the last 12 months. Julie Biel, a line that's popped out in your research, your communication over the last couple of months to me repeatedly, is this idea that summer will be a consumer health head fake. That's an idea that you've been pushing for a while now. Can you walk us through it, and what's the update?
Well, I think if you look at what we're expecting for the summer, it's very much a function of holiday travel, because we've been all cooped up. We're so super excited to be out and traveling. Airplanes are full. Great content on Instagram, let me tell you. People in bathing suits, it's looking really good on the Riviera. But I think if you think longer term, people have been saving for these holiday breaks. We get into the back to school season, employment might not be so strong, savings have been spent down, we get to back to school, and I think that's going to be the first indication that the consumer might not last quite as long as we had hoped. And I think holiday is going to be a real mess, because so much of the inventory that was ordered was before the war. There's going to be a real excess of it. You know, the supply chains have been really frazzled, but I think they dump a lot of inventory right when the consumer is starting to pull back.
Julie, Sri thinks I'm going to ask him about influencers on Instagram now. Sri, I'm not. Don't worry. I am going to ask you about the strength of the consumer, though, and corporate America. I hear it a lot. The consumer's resilient. Corporate balance sheets are strong. Sri, do you see the same thing?
Yeah, the consumer side, have to agree with Julie there a little bit. I mean, although not on the Instagram-related comments, not as clued up on that. But the thought process here would be that obviously average savings have kind of started coming down below average, below the historical averages, i.e. the year-to-date numbers look weaker. And you do feel like the pinch with respect to excess savings being drawn, also being more significant in the low-income categories. So kind of our estimates would be 10% of the excess savings were drawn in the first half of the year, and another 10% likely to be drawn in the back half of this year. So which would mean that particularly these draws are going to be more aggressive with the low income categories, which are much more impacted by the inflation dynamic. So I think that's kind of where you are going to see more pain with respect to some degree of consumer weakness also, I mean, cannot be completely ruled out. And similar story with respect to corporates. It's not really about the median or the average corporates feeling the pinch of these rate hikes, and it's not the higher quality companies. This is going to be much more about the low end, the tails of the corporate credit market, particularly in the lower quality floating rate oriented capital structures. That's where we need to see more of these. That's why we're likely to see more of these cracks pop up.
Are you seeing more dispersion in corporate credit just in the performance tree? Are you seeing that take place?
Yeah, I mean, I would say that June is when you categorically saw growth risk being increasingly priced in. And some of the indicators here would be the CCC BB basis, CCC significantly underperforming both in terms of spreads and in terms of the excess return dynamic through June. And the other element here is that the distress tail, the spread distress tail to be more particular. So the portion of the market which is trading greater than 1,000 basis points in high yield, that basically doubled through the course of June. So that to us kind of signals that the market's clearly getting more uncomfortable with the low end of the corporate credit market. And we are seeing more kind of price dispersion creep in there.
With that in mind, are you comfortable with the degree of spread tightening that we've seen in the last couple of weeks?
I mean, to be fair, that degree of spread tightening actually has been led by double Bs. So triple Cs are only like single digits tighter over the past couple of weeks. So it does feel like it is a higher quality rally, at least in the cash market. So it's not really uncomfortable to see that initial tightening come through. Although I do feel like this probably the momentum is likely to fade, and we would much rather think about this as a more range bound market until you get like clarity with respect to fundamentals evolving. And it does feel like earnings season, I would be a bit more concerned around potential downgrade catalysts picking up in portions of the market. So I think that's kind of why I would see the tightening in the low quality portion of the market as being like as something which is unsustainable. If it is higher quality led tightening, feels like you could, I mean, that is justifiable.
Judy, does that resonate with you when it comes to equities? From the perspective of corporate earnings, do you expect to see the same thing, a concentration in particular parts of the market?
Absolutely. I think we're going to finally start to see real dispersion between the higher quality and the lower quality. A lot of the sell-offs we've seen, particularly in categories like tech, they've been broad-based and pretty indiscriminate. I think now we're going to start to see some differentiation between businesses that have real cash flows, real earnings, real proper growth prospects in front of them, and companies that are lower quality, perhaps some of the newer vintages of IPOs, are going to really struggle because this is a tougher market for them. Capital is not free anymore, and it's much more difficult to navigate an environment where your investors still expect growth, but they want your margins to improve too.
We'll pick up on the energy part of that story in just a moment. Judy Biel there, Sri Sankaran sticking with us. Equities up 0.8% on the S&P, on the Nasdaq up by almost 1 full percentage point. Goldman this morning, Shonali Bassett, Goldman looking good. Those numbers were pretty decent.
Goldman is looking good. Remember, Goldman not only beating on fixed income trading, but also posting a really big jump in equities trading, coming in with a percentage jump just shy of what you saw over at JP Morgan and very close to what you saw in pure numbers at Morgan Stanley, which is traditionally the leader of the pack. Those there, John, are market share gains. You also are seeing Goldman rising significantly more than the others when it comes to advisory. $1.2 billion in advisory fees is pretty incredible in this type of a market. That's about double what you saw at Morgan Stanley. Now, I do want to shift stories a little bit because they do talk about underwriting pipeline here that is still very weak going into the second half of the year, and that is something that is also impacting the others. Look at this right here, the cost of bad loans. These are the spread widening you've seen. This is the cost of doing business in this kind of environment. The spread widening, mark-to-market write-downs you're seeing with Bank of America taking $320 million worth. The rest of the banks you see there have also taken some hundreds of millions of dollars in losses. But you have to wonder, if you start to see these kinds of write-downs, how much risk will the banks keep on taking on? Let's talk about the trading books, because even though you're seeing some impressive numbers out there, the value at risk is rising. And I like to show you Goldman Sachs here because you see exactly where they're taking on that risk. This is what helped them with that beat there, John. It's interest rates. More than anything else, $104 million worth of daily average trading value at risk. Remember, these are not pre-2008 levels of risk by any means, but you are seeing the banks working harder to make money at those trading desks.
Did we get a sneak peek at the Gorman, Fraser, Diamond, Moynihan crystal ball about the year ahead? Where are we?
They're striking a lot of confidence, right? You see it over at Bank of America, but I have to say something about Bank of America. Again, the numbers tell the story more than the words do. Bank of America's average FICO score for their consumers less than 660. It's only 9% of their book, rather than 12% a couple of years ago. So you have to wonder whether the economy is getting brighter or the banks are just taking on less risk among their customers.
Interesting. Shonali, great work as always. Shonali back with us in about 20 minutes' time around the opening bell. She'll get on that call and listen in for you. Futures right now down about 0.75%. Coming up, President Biden returning from the Middle East.
I'm doing all I can to increase the supply for the United States of America, which I expect to happen. The Saudis share that urgency. I expect we'll see further steps in the coming weeks.
That conversation up next.
We had a good discussion on ensuring global energy security and adequate oil supplies to support global economic growth, and that will begin shortly. I'm doing all I can to increase the supply for the United States of America, which I expect to happen. The Saudis share that urgency, and based on our discussions today, I expect we'll see further steps in the coming weeks.
President Biden returning from the Middle East, the Saudi Crown Prince Mohammed bin Salman leaving production hopes to OPEC, saying the following: the kingdom will play its role in this era as it announced increased level of maximum sustainable production capacity to 13 million barrels per day. Beyond that, the kingdom will not have any further production capacity. The Biden administration, however, staying optimistic.
Based on what we heard on the trip, I'm pretty confident that we'll see a few more steps in the coming weeks. It's not just about Saudi. It's about, we met with the GCC and with Saudi Arabia. There is additional spare capacity. There is room for increased production.
For more, let's get down to DC and catch up with AMH. Anne-Marie, great work over the last week. Walk us all through it. What can we expect in August from OPEC?
Well, we just don't know exactly yet, because while you hear the administration, the president himself has made energy advisor Amos Hochstein come out and they say in the next few weeks, we are expecting the group to increase more. What you heard from the Saudi side almost immediately after the president spoke was that it really decides about OPEC Plus is where the market is right now in terms of supply and demand. And at the moment, and the past few weeks, you did have the market claw back a bit due to recessionary concerns. So the Saudis are saying this is the decision that has led up to OPEC Plus. And Jonathan, we should note it's really only two countries that could help the administration when it comes to OPEC Plus. A number of countries aren't meeting their quotas. Potentially Saudi Arabia and the UAE can help a little bit, but together they have just under 3 million barrels a day. And even there is some critics who say potentially that number is even narrower. And then, of course, there's a prospect of a decision is made, potentially more production in August. Then it needs to creep into the market. That'll be the fall. Very close, and the president needs gasoline prices down in November.
Anne-Marie, just briefly, where does Europe fit in here? And why weren't they a bigger part of this conversation over the last week?
Well, I think they are in the fact that Mohammed bin Zayed is going to be meeting with Emmanuel Macron. I think one potential where Europe fits in is how they're going to get their oil in the future. Because remember, those sanctions are going to start to hit deeply at the end of the year, that Russia is going to not really be a destination for crude setting into Europe. So most of the Gulf production goes to Asia. I bet a big ask is going to be what kind of shipment can be rerouted to Europe.
Anne-Marie, are we starting to see the crude come from Russia, go into Saudi, then the Saudis just boost exports? Is this moving the deck chairs? Are you starting to see data that backs up that idea?
There is data that shows that more Russian crude is entering the Middle East than really ever before. And there are reports that a lot of that is going to Saudi Arabia. Now, what they'll do in the Middle East is use that for their own domestic consumption and then be able to have a little bit more to backfill to push out. So potentially, Jonathan, you could see the Saudis be able to come to the Americans' help, but only because they're importing more Russian crude.
Amazing. Anne-Marie, thank you. And again, brilliant work over the last couple of days to try and make sense of what's going on. Banker with us, Sankaran, Judy Biel. Judy, good news for the president and for Americans too. The average price of gasoline since the middle of June, I think it was June 13th, every single day has been coming down. Something else that's been coming down, S&P 500 energy names, they're down 25% off the highs of June as well. Now, Judy, I've been told repeatedly that what is happening right now, supply and demand, is good for energy profits through the rest of this year, but it doesn't seem to be that way for the stock. What's important to you?
I think, long term, we look at these pricing declines as being an alignment, right? Because it's only recently that gas prices have been declining. But if you look at crude, it's actually been on the path down for much longer. So it just seems to be on a bit of a delay. Energy companies writ large, the larger ones definitely have a little bit more impact on their own destiny. Smaller ones, I think, are really beholden to the commodity price writ large. That's why we as long-term investors are not so interested in the energy play. But what I would say is I think if you look longer term, the fundamentals are still really murky because we just don't actually know how the deck chairs are going to be shifted, as you guys have said. It's, thinking about why there would be a benefit to the U.S. economy with Russia actually importing gas to Saudi Arabia. It has an impact geopolitically in terms of what Biden can really do and what Biden can really negotiate in terms of easing this crisis in Ukraine.
Sri, we picked up on the European point with Anne-Marie just then as well. I'd love your thoughts on what the continent faces. You weren't, let's say, that pessimistic about U.S. corporate credit. Where do you stand on the European situation?
I think the way to think about this would be that the downside scenario for Europe obviously looks much more kind of significantly weaker than it is in the U.S. But at the same time, there again, if you look at the price action through June, the distressed tails in Europe have been kind of much more sharper in terms of the magnitude of adjustment that we have seen. So, I mean, it feels like the bear case scenario for Europe could look worse. And to some extent, the market's already reflecting, or at least beginning to price in, that bear case scenario becoming, at least it's pricing in a higher probability of that bear case scenario playing out. So it is a rational reaction that we are seeing from markets. But yeah, I mean, it does feel like the growth concerns are going to be more front and center in Europe. And as far as the policy alternatives are concerned, clearly the balancing act with respect to peripheral spreads also becomes another kind of function that the ECB has to optimize for. And that's where the difficulty is going to lie. Just a bit difficult. We've got to work out what this anti-fragmentation tool actually is. And I've got no idea how it's going to work. Sri Sankaran there. And Judy Biel, looking ahead to Thursday for the ECB, and I keep bringing this one up. What's more important, the European Central Bank on Thursday or Nord Stream 1 coming back online, and we're absolutely clueless as to how much gas is going to come through it? I've said it about 50 times already this morning. Europe in a very, very sticky spot going into the back end of this year. Up next, your morning calls, and later, wrapping up big bank earnings. We'll get Shanali to break down the numbers. We'll catch up with Jeff Harte of Piper Sandler, maintaining overweights on Bank of America and Goldman Sachs. And we'll catch up with BlackRock's Tony Despirito, focusing on stability and resilience in the second half. Those conversations coming up around the opening bell, with equity futures shaping up positively this Monday morning. We're up 0.8% on the S&P from New York. This is Bloomberg. I'm tempted to call it risk on, but as we all know, we've got no idea how long this will last. But for now, 5 minutes away from the opening bell, that's what we see. Equities up by 0.8 on the S&P, on the Nasdaq up 1 full percentage point. Yields a little bit higher through much of this morning. If you switch up the board and get to the bond market, 10-year yields higher by 6 basis points, lower through most of last week, down 15 or 16 basis points. The 2-year, for the first time in a long time, pretty well anchored through much of last week, with the exception of last Wednesday after CPI. Your 2-year this morning up 5 basis points. That's the price action. Here are your morning calls. Morgan Stanley downgrading Fox to equal weight, 38 price target, expecting recession fears to weigh on the company's ad revenue. Next up, Goldman upgrading Yum Brands to buy from a sell, saying the company is well positioned to navigate a slowdown in consumer spending. And finally, Berenberg upgrading JP Morgan to a hold, 120 price target, seeing limited downside risk given the temporary nature of the bank's headwinds. That stock is up by about 0.9%. Up next, big bank earnings marching on after recording their best day of gains in over 18 months. That conversation with BlackRock's Tony Despirito and Piper Sandler's Jeff Harte around the opening bell. Your opening bell is up next. Live from New York City, let's get this trading week started for you. Good morning to you all. This Monday morning, here's your price action, up 0.9% on the S&P 500. On the Nasdaq 100, up about 1 full percentage point. On the Russell 2000, up a little more than 1%. That's the opening bell. Switch up the board and get to the bond market. Some really big moves this year. You know them well. We're up 5 basis points this morning to 296.88. We've had a long look at life below 3% again, though. You're getting comfortable? Do you think we've seen the highs already? That debate on this programme has been split right down the middle over the last month or so. In the FX market, euro showing some rare strength against the weaker dollar this morning. Euro dollar up 0.6% at 101.43 Thursday. Who wants to be President Lagarde on Thursday, hiking interest rates into what could be a recession later this year in Europe? That is a tough spot. Crude positive 4%, a rough couple of weeks for crude, that's for sure. Gas prices keep coming down. I know many of you want to see that. Crude rallying again, though, bouncing back this morning. At the opening bell, about 40 seconds in, let's get you some movers. We can do that. Here's Taylor Riggs.
Hey, John, going to quickly touch here on the banks. Not going to get too much into it because I know our expert, Shanali Bossack, of course, waiting to really do a deep dive. But, of course, you've B of A missing a little bit on the bottom line, but rates are rising. And the net interest income, of course, getting a little bit of a benefit. Goldman Sachs as well seeing some good trading revenue and bond revenue. So that's really helping those companies a lot. Change up the board here, and we'll take a look at some of the other movers outside the financials. Boeing getting a really good order here. 100 new 737 MAX 10s from Delta could be worth about $18 billion. Chips are also higher. There is some news, and RBI analysts are saying that CHIPS Act to help onshoring of that chip manufacturing more likely than not to be passed this year. We've talked a lot about the big banks, but Synchrony Financial, more of a retailer, a credit card lender here, of course, to those, actually saw that bottom line rise as well. And I'll end again on another positive note. MicroStrategy up. I hear Bitcoin is the highest in 5 weeks, John.
A lot of green out there this morning. Taylor, great to catch up with you. Some tech earnings coming up in the next 24 hours as well. We'll get Netflix, I'm told, after the close tomorrow. Looking at the numbers right now, up 0.8% on the S&P, about 1:45 into the session. Energy top of the pile, up 2.5% off the back of what's happening in the commodity market today. Crude rallying. Financials up by 1.35%. The numbers from Goldman, pretty decent. Here are the soothing words of David Solomon, the CEO. He says this: despite increased volatility and uncertainty, I remain confident in our ability to navigate the environment, dynamically manage our resources and drive long-term accretive returns for shareholders. Shonali has more. Hey, Shonali.
Hey, John. David Solomon is sounding more soothing by the day, even though some pipelines are declining when you look at underwriting. You look at what's happening at the trading desk over there. That significant beat they had both in fixed income and equities trading helped those helps that stock rise higher by 4%. Remember, Goldman was trading at less than book value heading into this earnings season, and you're looking at them beat on all fronts, keeping expenses in control, keeping compensation and benefits expenses in control, while also showing that they can perform. You look at Bank of America also rising. You have Brian Moynihan saying that Bank of America has added 1 million checking accounts in the last quarter alone. So you have Bank of America doing also what it does best, even in the face of slightly missing Wall Street expectations in some areas and not keeping those expenses as in control as you see over at some of its rivals. Bank of America did book some costs tied to regulatory concerns and is also looking to grow headcount in some areas while cutting in others. This is going to be finding a sweet spot all year long as the environment gets tougher, John.
Are they going to give us any interest on our savings anytime soon?
Well, you're not seeing it at Bank of America happen very significantly. It's just, a couple of basis points really you're getting on your checking accounts. But over at Marcus, you're getting 1.2%. So the question is, what's the cost of bringing that extra consumer on?
1.2%, and apparently it still doesn't really get it done in a major way. Shonali, thank you. Shonali Basak there on the latest. And Shonali, great work as always. Every earnings season on Wall Street. Equities then, looking decent. Goldman better than good. The stock is up by 4.7%. CFRA's Ken Leon. We caught up with him a little bit earlier. Take a listen.
You go to reality today, it's really, I don't think the banking industry is going to have lower loan activity in the second half of this year versus the first half. And then we have to play the recession scenarios for 2023. But if they start building reserves in the second half of this year, that could be good fodder for earnings push-ups in 2023.
This morning, we're lucky to catch up with Piper Sandler's Jeff Harte. He joins us now to discuss these numbers. Jeff, great to catch up with you. I know you like B of A. I know you like Goldman. Do you like what you hear this morning?
Yeah, I mean, for Goldman, the reported numbers were great. FIC really stood out, and that's something they've always kind of been the best at. They showed it this quarter, so there's a lot to like there. For B of A, the headline number was a little light, but if you adjust for some rather large regulatory charges, they actually, it came in a little better than expected. And the big news came on the conference call when, management gave guidance for net interest income to be up materially more than the street was expecting over the next couple of quarters. So that whole higher rates, asset sensitivity really kicking in for B of A, it appears.
Well, let's talk about the rate sensitivity. Jeff, it's been a tough year for some of these names. I think a lot of people tuning in and watching this right now saw the rate hikes coming, thought the banks would do well. They haven't. I'm trying to work out what's good for profits and what's good for the stock. Is there a difference there?
There is, and there certainly has been. I mean, higher rates has been expected for a while. Now, what we're seeing is the benefit from those higher rates is more than people were expecting, but the concept had been expected for a while. The big concern now, at least from what I hear back from investors, is on credit. If we're actually heading into a recession, most of the credit metrics are still as good as we've ever seen them. How bad do they have to get? And that's kind of what the market's kind of looking ahead to. As we sit here now, you got to figure credit's not going to stay where it's at. It has to get worse. but certainly not as bad as, say, we've seen in prior recessions, because there's just not a lot of bubbles to pop. I mean, there's not a lot to really go wrong there. But that really seems to be, I think, where investors are focused. So if we can get some more stability in kind of the markets and the economy and kind of get an arm around what credit losses ultimately could be, that's probably the real key for a kind of general bank stock leg up here.
Goldman's had a massive leg up in 2 days, that's for sure, up about 10% or so in the last 2 sessions. Jeff, you touched on something important, though. The strength of corporate balance sheets, the consumer, the credit situation in this country. Does that put a cap on the downside for some of these banks, or does it actually unleash some upside for some of these banks into year end?
Well, I'd like to say it puts a cap on the downside. In theory, it should. But if we start talking about not a mild, quick recession, but a deep recession, really bad economic numbers, I mean, look, the banks finance the economy, right? They lubricate the economy. If the economy goes the wrong way, that's going to be bad news for banks. So barring a real deep recession scenario, it should give us some support on the downside. And then that kind of upside pop comes when, you know, maybe we actually start seeing credit costs go up, and they don't go up as much as people feared. It's kind of the unknown on the credit side. I think the risk is viewed as being larger than the return. Things can't get much better, but in theory, they could get a lot worse on the credit front.
Hey, Jeff, great to catch up with you, to get a bit of time on 2 names that I know you like and have performed well this morning, that's for sure. Jeff Harte there on the latest. Goldman with a really nice rally this morning in the early part of this session. We're up by almost 6 percentage points now. Speaking about more broadly what's going to happen with this market and what's happening with earnings, Morgan Stanley and Goldman still warning the stocks have yet to find a bottom. Mike Wilson had this to say coming into this week. The counter trend rally may continue, but make no mistake, we don't believe this bear market is over, even if we avoid a recession, the odds of which are increasing. With more, here's Kayne.
Well, John, ever the bear, Mike Wilson says the odds of a recession over the next 12 months are about 36%, but you don't even need a recession to see equity markets continue to go lower. He's really looking at profit margins here, and he says he doesn't really buy the expectations that margin pressures are going to ease beyond the second quarter due to the combination of higher costs from things like labor and raw materials coupled with decelerating demand. And he adds that even if estimates for revenue growth were to remain static, a return to pre-COVID net margin levels implies a 10% hit to forward earnings per share. David Kostin over at Goldman Sachs, meanwhile, also talked about that idea last week. He says he expects the weak macroeconomic outlook to threaten company's profitability. And his colleague Peter Oppenheimer was on Bloomberg television earlier this morning warning that it's premature to say inflation will come down, saying that even if headline inflation starts to go lower, consumer prices aren't necessarily going to follow suit in quick order. Given the concerns that are out there, we've seen a number of strategists tempering their views on the trajectory of equities, bringing themselves down a little bit closer to the camp Mike Wilson is in. Downgrades from the likes of Bank of America, UBS, Piper Sandler, Oppenheimer, just in the last 10 days or so. We now have the average target for the S&P at year end sitting at 44.42, down about 175 points from where the average was in mid-June. But take a look at that EPS estimate, down just $1 to $2.26, John.
Kelly, nice, thank you. Always enjoy reading the work of Mike Wilson and Morgan Stanley. I looked to Seth Carpenter's work of Morgan Stanley over the weekend. I'll catch up with Mike McKee in about 10 minutes on it. There's a number in there, a stat on the BOJ. The BOJ now owns about 50% of the outstanding JGB market. We're going to touch on that a little bit later. I'm not even sure we should call it a market anymore. Let's get the view of BlackRock. They see some opportunities despite the rocky start to the year. They write the following: while caution is warranted, we believe the equity risk premium continues to make a case for equities. Stock valuations have come down. Company earnings remain solid. Tony Despirito joins us right now. Tony, I was looking forward to this. You talked about the optimal portfolio to combat a recession versus one to combat inflation. How different are they?
Well, the truth is they're very different. To combat inflation, you want a very cyclical-oriented portfolio, stocks like energy stocks, bank stocks, et cetera. To combat recession, you want more stable compounders, healthcare staples, utilities, the like. And so, given the amount of uncertainty out there, what we've been saying is, look, really balance out those risks, create a barbell portfolio. You know I'm a big fan of a barbell portfolio, but let's tilt that barbell portfolio a bit more towards the recession resilient side, particularly emphasizing healthcare, which in the portfolios I run is our single largest sector weight by far.
Tony, why do you think that particular sector on that side of the barbell is still underappreciated?
Yeah, well, first of all, when I look at the long term, I think healthcare has a great outlook. Healthcare grows faster than GDP because we're aging as a society. And that really distinguishes it from other recession-resilient sectors like utilities and staples, which, if you look over long periods of time, actually fall as a percent of GDP. Healthcare is very recession resilient. It's proved so in the past. I think it'll be again in the future. In fact, it might be more recession resilient in the future because more of the payments are coming from government, whether it's larger Medicaid rolls. Our older population means more people on Medicare, and then the exchanges and the subsidies that go with those exchanges. And then finally, when I look at valuations, the valuations of healthcare stocks are still below market multiples, whereas staples and utilities have been bid up above market multiples. And so all those reasons lead me to more investments in healthcare than either of those other two sectors.
The piece of the other side of the barbell that I wanted to discuss were financials. Energy will resonate with a lot of people as the optimal inflation fighter because it is the source of inflation right now and has performed really well up until recently on the S&P. The financials haven't delivered, Tony. The profits might have in certain pockets, but the stocks haven't. Tony, what do you make of that?
Well, I view that positively because that means the valuations are even better at the moment. We're seeing a slew of bank earnings right now, and very consistent themes. Net interest income, really strong. We're seeing rising net interest margins, higher than people might have expected, and that's simply because banks are awash in deposits, so they don't need to raise rates that much on deposits, and rates on assets are going up much more quickly. Plus, we're finally seeing loan growth for the first time post the pandemic. So net interest income very strong. For the money center banks, we're seeing great numbers out of their trading books, and that's because the market's been so volatile. And so that's a nice kind of cushion, if you will, counter-cyclical cushion that they have. And so I like the fact that earnings are strong. Obviously, as discussed in the previous segment, we've got to watch credit expenses. But one of the things I like, particularly in this quarter, if you look at net charge-offs versus what they're accruing for loan loss reserves, they're building loan loss reserves, meaning they're taking more expenses on the income statement than is warranted by what they're charging off. That means they're preparing to cushion on the downside should the economy slip further.
That raises the big question, Tony. That raises the big question. The relationship between rates and underlying profit, net interest income, all of the above, that's well understood. The relationship between rates and stock performance at this stage of the cycle, Tony, that's the important piece of this. What is the relationship between interest rates climbing and stock performance at this stage of the cycle when a lot of people are looking for a recession potentially in the second half of this year?
So right now, as you point out, there's a lot of fear about the economy because of rising rates. I think that's the opportunity on this side of the barbell, is that these stocks are just too discounted for what the fundamental outlook is.
Do we need the recession risk to fade, though, for that to start to deliver?
Yeah, I think that is once we see the credit losses actually come through and see that they're not that bad, I think that's when the stocks will probably deliver in all honesty. And, when you look at the last couple of recessions, obviously the pandemic, credit was extremely pristine, actually, through the pandemic. The global financial crisis, credit was horrible. I don't think it'll be either. I think it'll be somewhere in between, much more akin to what we saw in the early 2000s. And when you look at valuations, that means these are long-term good bets.
Tony, awesome to get your views, particularly on the healthcare story, which hasn't been talked about enough in many ways. Tony Despirito there of BlackRock. Goldman up by 5% this morning in the early part of the session, about 15 minutes in. Goldman looking better than good over the last couple of days. Coming up, rate decisions from the BOJ and the ECB.
The recession is our base case. It's a mild recession, even with the Russian gas start flowing again. But obviously the risks are for a much deeper recession.
That conversation up next.
think that the ECB needs to do any front loading. We expect 25 basis points now. We expect 50 basis points in September, another 25 basis points in October, and then we think that actually the ECB will pause. Will pause because the recession is our base case. It's a mild recession, even with the Russian gas start flowing again. But obviously the risks are for a much deeper recession.
What a tough spot for the ECB. I'm looking at euro dollar right now, 101.57. A rare day of euro strength, up 0.75% against a weaker dollar in G10 today. I made a list of what's going against the euro right now over the last few months, year to date. Fed rate hikes, uncertain European energy supply, messy Italian politics, a messy Italian bond market, upside inflation risk, downside growth risks, and rock ECB in a hard place. They are in a tough spot. The ECB and BOJ on deck this week. Morgan Stanley's Seth Carpenter, wary of the Bank of Japan's balance sheet. Great work by Seth. If you take a read of the research, reach out to the team to have a look at it. The BOJ now owns approximately half of the JGB market. Our forecast that no change is made until next year on yield curve control implies substantial upside risk to the size of its balance sheet. It could get bigger. Mike McKee has more. Hey, Mike.
Well, John, you know the headlines. The ECB is expected to raise rates for the first time in a decade, while the Bank of Japan is expected to hold steady. Whether or not Seth Carpenter thinks that's a problem, but you can see why when you look at the inflation rates. The ECB is supposed to keep inflation down, and they are at record levels right now. The Bank of Japan has been trying to get to 2% for a decade or more. They've just gotten there on inflation. So they're not expected to move yet, even though there are concerns about the balance sheets. It's the ECB that'll get the headlines this week because it is a tough decision, as you mentioned, for Christine Lagarde and company. I thought you were going to say Lionel Messi when you were talking about all the messy things there. But record inflation, they've got to have a rate increase of some sort sometime soon. Recession odds are rising as those energy prices soar. And it's interesting, we will find out on Thursday, same day as the ECB meeting, whether the gas gets turned back on from Russia after being down for maintenance. Eurozone fragmentation, a growing issue if there is a recession or a downturn. Does Italy just blow out? Well, we don't know how they'd react because the Italian government is near collapse. So an awful lot of cross currents for the ECB to worry about. Bank of Japan, as I mentioned, not going to do anything now. They will keep their rate below zero, where it has been since, I don't know, John, you were little. They have kept it that way for about 7, 8 years now. And the Bank of Japan then is, if they can keep inflation where it is, likely to start discussing how they get out of it. But everybody worries about how you get out of yield curve control without the market front running you and blowing up everything you're doing.
It's been a long time, Mike. We've been talking about negative interest rates for 8 years. Haven't seen a rate hike from the ECB since when? 2011? With Trichet? Skip Draghi. He didn't have to do one. The ECB, Mike, on Thursday, I wonder if that is the big event. Do you think it could be Nord Stream 1 coming back online and us remaining clueless as to how much gas will come through it?
Well, that could be certainly the issue. Within a day or so, we'll know. And, of course, the market will reprice. If no gas comes through, then the ECB is going to wish it cut rates, perhaps. If the gas does flow, then they're going to be happy they raised rates. It's a really tough decision and extraordinarily bad timing for them.
I wonder if these inflation prints weren't where they were, if this ECB would actually be talking about easing, not tightening, and we can get to that another time. Mike, I want to bring you this line from Goldman. The stock's up 3.8%. We've done the numbers, all of that. Just getting some communication from the C-suite. They're going to slow hiring velocity. What do you make of that phrase, and how much of that have you been hearing?
Well, I haven't heard that phrase before, but I have heard companies start to talk about not hiring as many people. They still have openings, but if the economy is going to turn down, they don't want to go too far in hiring people. And we've seen that effect, particularly in tech, where they're rescinding some job offers that they made because they're afraid that they might have to lay people off if the economy does indeed turn down significantly.
That is brutal. Pulling back an offer you've already made and it's been agreed on. Yeah. Mike, thank you. I don't like that, and I know you don't either. Coming up, the market moving events you need to be watching. That'll be next in your trading diary. Netflix this week, reporting earnings after the close tomorrow, after we leave the big banks on Wall Street behind us. That's next. This is Bloomberg. So far, so good. Will it stick? I've got no idea, but so far, so good. Stocks up, yields up, dollar weaker. Equities now at 1% on the S&P 500. That's the price action. Here's your trading diary. The White House press secretary holding a news conference at 3 Eastern. Eurozone CPI, Netflix earnings coming tomorrow, plus US housing starts data too. Tesla reporting earnings on Wednesday. Rate decisions from the BOJ and the ECB coming out on Thursday, alongside another round of jobless claims in the US. And finally, US PMIs rounding out the week on Friday. Looking forward to covering those stories with you right here on Bloomberg TV from New York City. This was the countdown to the open. This is Bloomberg.